Hello everyone, and welcome back to the channel. Today, we're re-diving deep into a side of the Cold War you probably haven't heard much about. The financial front. Forget spies and missile silos for a moment. We're talking about rubles, gold, and international banks. They didn't need Wall Street, they built their own. This is the incredible, and often overlooked, story of how the Soviet Union tried to weaponize finance to challenge the capitalist world. When the Bolsheviks seized power in 1917, one of their first acts was to declare all foreign debts null and void. Imagine that! It was a massive financial bombshell, sending shockwaves through the global markets of London, Paris, and New York. This wasn't just a political statement. It was an act of economic warfare. They were essentially saying, your financial rules don't apply to us. This move immediately isolated the new Soviet state from the international financial system. But far from being a weakness, they intended to turn this isolation into a strength. They envisioned a completely separate economic bloc, a socialist alternative to the dollar-dominated West. To achieve this, they needed their own banks, their own rules, and their own way of doing business. In the early 1920s, the Soviet Union established a network of state-controlled banks abroad. You had institutions like the Moscow Narodny Bank in London, the Warsaw Handelsbank in Zurich, and the Eurobank in Paris. On the surface, these looked like ordinary commercial banks. They handled trade financing, currency exchange, and took deposits. But underneath, they were instruments of the state, directed by Moscow. Their primary mission wasn't just profit. It was to secure the hard currency dollars, pounds, and francs that the USSR desperately needed to industrialize and to project its power. These banks were financial embassies, operating behind enemy lines in the heart of the capitalist world. One of their most potent financial weapons was gold. The Soviet Union was a major gold producer, and they weren't shy about using it to manipulate markets. Throughout the Cold War, the Kremlin would strategically sell massive quantities of gold. Why? Sometimes, it was to raise cash to buy Western grain after a bad harvest. But other times, the motives were more strategic. By dumping gold onto the market, they could drive down its price. This put pressure on Western currencies, especially the US dollar, which was pegged to gold under the Bretton Woods system. A sudden drop in the gold price could cause instability, panic, and sow doubt about the strength of the capitalist financial order. It was a subtle but powerful way to wage economic warfare without firing a single shot. Then came the birth of a truly ingenious and ironic financial innovation. The euro-dollar market. The name is a bit misleading. It has nothing to do with the euro currency we know today. In the tense climate of the Cold War, Soviet-owned banks in Europe were worried. They held vast sums of US dollars, but they feared that if tensions escalated, the United States government could freeze their assets held in American banks. So, what did they do? Instead of depositing their dollars in New York, the Moscow Narodny Bank in London started depositing them with other European banks. These were US dollars held outside the United States, and therefore outside the direct control of US regulators. This created a massive offshore pool of dollars. Western banks quickly saw the advantages for regulations, higher interest rates, and jumped in. Ironically, a Soviet move to protect its assets from American control ended up creating the foundation for the modern globalized financial system. They accidentally supercharged the very system they sought to undermine. The Cold War raged on. The Soviet Union also used its financial muscle to support its allies and spread its influence. Through an organization called Comecon, or the Council for Mutual Economic Assistance. Moscow created its own version of the World Bank and IMF for the Eastern Bloc. They established a system based on something called the transferable ruble. The idea was to create a socialist international currency that could facilitate trade between communist countries without having to rely on the US dollar. offered massive loans and subsidized energy to countries in their sphere of influence. From Cuba to Vietnam, this was checkbook diplomacy, Soviet style. The goal was to bind these nations tightly to Moscow's orbit, creating an economic bloc that was dependent on and loyal to the Soviet Union, forming a self-sufficient alternative to the capitalist world. But this grand financial experiment had a fatal flaw. The entire Soviet economic system was built on central planning, not market forces. Prices for goods and the value of the transferable ruble were set by bureaucratic decree in Moscow, not by supply and demand. This created huge inefficiencies. For example, Poland might be forced to sell ships to the USSR at an artificially low price, while buying Soviet oil at an inflated one. The system was rigid, unresponsive, and bred resentment. Unlike the dynamic and innovative Western markets, the Soviet financial bloc was stagnant. 2. There was no real price discovery, no genuine competition. It was a closed loop, increasingly disconnected from the economic reality of the rest of the world. The beginning of the end came in the 1970s and 80s. The oil shocks of the 70s gave the USSR a temporary windfall, as their oil exports brought in a flood of hard currency. But instead of using this wealth to reform their creaking economy, spent it on a massive military buildup and costly foreign interventions, like the war in Afghanistan. They became addicted to oil revenue. When oil prices crashed in the mid-1980s, the Soviet economy went into a tailspin. The hard currency they needed to import grain and technology dried up. Their state-run banks abroad, once instruments of power, were now scrambling to secure loans just to keep the country afloat. The hunter had become the hunted. They were now at the mercy of the very Western bankers they had once sought to overthrow. This system was cracking under its own weight. The inefficiency of central planning, the crushing cost of the arms race, and the collapse of oil prices created a perfect storm. The satellite states in Eastern Europe, burdened by debt and economic mismanagement, grew increasingly restless. The financial glue that held the Eastern Bloc together was dissolving. Mikhail Gorbachev's reforms of glasnost and perestroika were a last-ditch effort to save the system, to introduce market elements without surrendering control. But it was too little, too late. The economic rot was too deep. Once people got a taste of economic and political freedom, there was no turning back. The Berlin Wall fell not just because of political pressure, but because the economic system behind it had gone bankrupt. Though, the story of Soviet finance is a fascinating tale of ambition, innovation, and ultimately, failure. They tried to build an alternative financial universe, one governed by ideology instead of markets. They created their own banks, weaponized their resources, and even accidentally sparked a global financial revolution with the eurodollar. But their system lacked the dynamism, flexibility, and efficiency of its capitalist rival. It was a rigid structure in a fluid world, a planned economy fighting a market-driven one. In the end, ideology lost to the math of markets. Thank you so much for joining me on this deep dive into a forgotten corner of Cold War history. It just goes to show that the biggest battles aren't always fought with tanks and planes, but with balance sheets and bank accounts. If you found this interesting, please hit that like button, subscribe for more content, and let me know your thoughts in the comments below. See you in the next video.